On January 30th, 2026, the silver market did something not seen in a generation. It fell off a cliff. In a single brutal session, prices plunged over 30%, a violent move that vaporized weeks of gains. Silver, which had been flying high at record prices, was suddenly in a free fall. But this isn't just a story about a precious metal. At almost the exact same moment, headlines screamed about a firestorm in the crypto world. A wave of liquidations, reportedly totaling $1.7 billion, was tearing through exchanges and wiping out traders. So how? How does a physical commodity literally dug from the earth seemingly trigger a multi-billion-dollar panic in the world of digital code? The mainstream narrative pointed to a single political appointment, but that's not the real story. Here's the part no one tells you. It wasn't a change in fundamentals that caused this crash. It was a catastrophic failure of the market's hidden plumbing. The leverage broke. And understanding why that plumbing broke is the key to protecting your portfolio from the next invisible shockwave. Because this event wasn't just a fluke. It was a stress test of the entire system. And what it revealed is either a warning sign of a deep rot or a once-in-a-generation buying opportunity. To understand the crash, you have to understand the mania that came first. By late January 2026, the silver market was a coiled spring. Prices had gone parabolic, surging on an intoxicating story, a massive supply deficit. The world needed more silver than it could mine, not for jewelry, but for the guts of our future. Solar panels, EVs, 5G, and the booming AI sector all run on silver. This powerful story was then supercharged by a macro tailwind. With US national debt rising, investors piled into hard assets as a hedge. Gold pushed past $5,000 an ounce, and silver, its cheaper, more volatile cousin, was seen as the high-stakes way to play the trend. It became a crowded elevator, with speculators leveraging up to ride the price to the moon. But in a mania, no one looks up to see the cable starting to fray. Then, the spark. On January 30th, reports surfaced that President Trump was nominating Kevin Warsh as the next Fed chair. To most, the name means nothing. To Wall Street, it means everything. Warsh is a known monetary hawk, an outspoken critic of the easy money era. The market, which had bet on a compliant, money-printing Fed, was caught completely flat-footed. The reaction was instant. The US dollar spiked, real yields rose, and for assets like gold and silver that pay no interest, that's poison. The selling began. But this is where the market structure turned a trickle of selling into a tidal wave. Think of it as a line of dominoes. The Warsh news was the finger that tipped the first domino. The initial price dip triggered margin calls for the most over-leveraged traders. They couldn't post more cash, so their brokers forcibly sold their positions. This forced selling pushed the price down further, toppling the next set of dominoes. Other traders automated stop-loss orders. A stop-loss cascade is a self-reinforcing death spiral. Forced selling triggers stop-losses, which creates more selling, which triggers even more stop-losses. And we have the smoking gun. Market data shows that during the crash, trading volume was enormous, but a key metric called open interest, the total number of contracts, was falling. That tells you positions were being closed out and destroyed, not that new sellers were entering the market. The speculators were being violently flushed out. And watching over it all? The algorithms. High-frequency trading bots, programmed to react to a rising dollar and falling momentum, went into overdrive. They sold faster and in bigger volumes than any human could, amplifying the domino cascade and pouring fuel on the fire. So, why did a crash in an ancient precious metal coincide so perfectly with a bloodbath in digital assets? The answer isn't a direct line. It's not as simple as silver crashed, so traders sold their Bitcoin. The connection is more subtle and says a lot more about modern finance. While social media buzzed about a $1.7 billion crypto liquidation, the reality is that both silver and crypto were victims of the same macro shock, amplified through the same channels. Think of it like this. Large funds and professional trading firms don't operate in silos. They view their entire portfolio, stocks, commodities, crypto, as one big pool of risk. When a massive shock like the Warsh news hits, The first instinct isn't to analyze, it's to de-risk. It's a dash for cash. With the silver market in a free fall and liquidity drying up, traders needed to sell whatever they could fast to reduce their overall exposure. For many, their most liquid holdings weren't just stocks, they were Bitcoin and Ethereum. So it wasn't a direct mechanical bridge where a silver margin call automatically forced a Bitcoin sale. It was a contagion of sentiment. Panic in one corner of the market forced a liquidity scramble that spread to all the others. The very structure of the modern market, built for hyper-leveraged efficiency, had become a transmission mechanism for panic. This wasn't a failure of Bitcoin or a failure of silver. It was a failure of a system built on a mountain of interconnected risk. After the dust settled, the market was left scarred. So the immediate question for any investor is, what now? The evidence strongly suggests this was a mechanical, leverage-driven crash, not a fundamental one. The reasons to own hard assets, structural deficits, industrial demand, sovereign debt concerns, are all still here. The crash simply performed a violent but necessary function. It flushed the system of weak hands. For investors, this creates a clear three-step playbook. Step 1, control your risk now. This event is a stark reminder that all markets are connected. The idea that any asset is a perfect island has been proven false. Review your own portfolio, and most importantly, your own use of leverage. In a systemic de-risking event, the person who gets the margin call always loses. Don't be that person. Step 2, reevaluate the opportunity. With the speculative froth blown off the top, the market may now be grounded in a more powerful, fundamental story. For those with a long-term view, this brutal correction could be the entry point they were waiting for. The paper speculators are gone, leaving the industrial users and long-term cash buyers. Ask yourself if the fundamental thesis is still intact. If the answer is yes, this is where you start paying attention. Step 3, know what to watch next. Don't trade blind. The key metrics to watch are clear. First, the US dollar. As long as it remains strong, it will be a headwind for hard assets. Second, key price levels. Many analysts are watching the $70 to $80 range in silver as a critical support zone. And third, watch the open interest data. A slow, steady rise alongside price would signal a healthier rally, not the return of reckless speculation. The great silver crash of 2026 wasn't just about silver. It was a stress test that revealed the hidden fragility of our interconnected financial system. It showed how a single headline could be amplified by leverage and algorithms into a cross-asset panic, linking the oldest form of money with the newest in a violent cascade. The bull case for hard assets, based on deficits and monetary concerns, wasn't broken. The speculative leverage built on top of it was. The invisible machinery of the market seized up, and for a few chaotic days, we all saw what happens when the gears grind to a halt. So what do you think? Was this a healthy flush out that has cleared the way for a more sustainable rally? Or was it a warning shot that this kind of contagion is the new normal? Let me know in the comments. And if you want to understand the invisible forces that truly move markets, subscribe and hit that notification bell so you don't miss our next investigation.